Today, the US dollar index has somehow recovered after a decline during the previous two sessions. However, the trade volume is likely to be small as most US investors have a day off today. Meanwhile, others are looking forward to the key rate decision that will be made by the Bank of England later this week. Traders will also focus on the US labor market figures slated for release on Thursday, as well as the PMI data that will be issued on a Friday and some other macroeconomic reports. Watch our traders' calendar to be abreast of the latest macroeconomic events and know how they may affect currencies. As is often the case, statistics can come with unexpected twists. For instance, the US retail sector registered a lackluster performance in May, with sales posting a meager 0.1% increase. The actual numbers fell short of forecasts. Moreover, April sales were revised downward to show a 0.2% decline, and this signals weaker consumer sentiment in the US economy, with the overall activity gradually slowing. However, the US dollar may also act against the rules. Such a negative report should have caused a slump in the currency. However, the greenback withstood, showing just a minor decline. It managed to stay above 105 points against a basket of 6 major currencies. It even attempted to rise just after the publication of fresh data. Thus, the greenback was supported by the industrial production report, which exceeded the forecast. Unlike the retail sales data, economists had anticipated a slower drop of 0.1% compared to 0.4% in the previous period. Instead, the indicator advanced by 0.4%. Such an unexpected rise made the US dollar more attractive and allowed it to keep its position. In general, the economic situation in the United States is worsening. According to the FEDWATCH tool, the likelihood of the key rate cut in September is 60–65%. It's highly possible that markets have understood the hint dropped by several Fed officials yesterday. The politicians said that they intended to wait for a stable decline in prices toward the 2% target. Now their focus has been shifted to the US economic health. The American economy set a new record yesterday. A steep rise in shares of AI chipmaker NVIDIA made it the most valuable company in the global stock market. As a result, Wall Street closed on a high note ahead of Wednesday's Freedom Day holiday in the United States. The S&P 500 index gained 0.25% to settle at its second record closing high at around 5,490 points. The US currency rebounded slightly in the early trade, hovering in a daily range of 105.20 to 105.40. The uptrend remains intact, supported by strong fundamentals and a decline in its major currency basket rivals, the euro, yen, and the pound sterling. The yen is losing value due to the stark differences in interest rates between the central banks of Japan and the United States. The pound sterling is trading under pressure from the easing inflation in the UK, and the country's consumer price index came in at 2% in May, down from 2.3% in April, as reported today. Meanwhile, the euro, the main currency in the US dollar index, is still suffering pressure from the situation in France and the whole eurozone. Nevertheless, the euro-dollar pair has been trading above 1.07 for the second day in a row, which points to considerable support. In this light, the volume of short orders has already dropped, thus allowing the pair to rebound and consolidate above the mentioned level. The euro is trying to benefit from the holidays in the United States. However, it's still hovering in a narrow range, slightly below 1.0750. The situation is likely to remain the same as the US markets are closed today. Once the price settles below 1.07 on the daily chart, the volume of short positions may surge. In the event of this, we may see downward momentum that will push the price to this year's low. If the price fails to settle below this control level, it may start a gradual recovery process. Meanwhile, oil has already started to recover. Interestingly, the main driving force behind this rally in crude oil prices is the same consumer demand that recently contributed to the decline. The asset is again in value despite the American Petroleum Institute's report showing an increase in crude oil inventories by 2.3 million barrels. Thus, Brent crude broke above the key resistance level of $85 early Wednesday. Over the past 10 trading days, the benchmark has added more than 10%. With the start of the holiday season, demand in the US has picked up noticeably, pushing the prices higher. However, as inventories rise, the market is becoming overbought. Against this background, traders may lock in profits on their long positions, thus triggering a technical pullback in oil prices. Please bear in mind that any technical signal may be ignored by market participants amid inertia. For now, oil is trading at a 7-week high, mainly due to the concerns of potential supply cuts or disruptions amid ongoing geopolitical tensions. How we're going to be in the short term in financial markets, we will definitely tell you in our next news releases. Subscribe to our channel and follow news with us. And see you soon!